Hello, my name is Raynor. I'm the Director of Business Advising here at Coastal Enterprises. CEI helps entrepreneurs in Maine start and grow their business. We offer informative workshops and interactive multi-session peer groups available live and online, as well as in person, in addition to one-on-one business advising. For more information about CEI, please visit ceimaine.org. Today, I'll put that away, got through that. We're going to be talking about preparing to buy a business and some of the considerations that you will be doing if that's something that you're interested in, and how to go through the due diligence process and ascertain whether or not buying a business is a good idea for you. So here's kind of an agenda of what we're going to talk about over the next hour or so. Feel free to skip around in this presentation if you want to skip to certain parts, but we'll talk about why to buy a business, what are the advantages of doing so versus starting a business from scratch. We'll talk about what you are actually buying, identifying the assets, both tangible and intangible, how you're buying it, terms and funding sources, and how to go about acquiring a business, depending on the purchase price and the allocation. Determination of value, we'll talk a little bit on. There's a whole field of study in valuation and opinion of value, but we'll talk about some of the basics and how to go through that process yourself and make sure you are not overpaying for a business. Talking about structuring a deal. And then we'll end with some best next steps and best practices for proceeding through the acquisition of a business. First things first. So why buy a business? There's lots of businesses out there. Maine is the oldest state in the country as of early 2026, which means we have a lot of business owners that are looking to retire and a lot of opportunities for individuals to acquire those businesses. Some reasons that come up as we're advising on this, people are tired of working for others. They want to keep, the investment that they're putting in themselves in terms of sweat equity and energy, but they don't want to recreate the wheel, right? There's a lot of nervousness around starting a new business because there's a lot of assumptions and uncertainty, right? Buying a business, you don't have to go through that process. You know that there's a set market in place. You know that there is a product or service that is in demand. You have existing customers in place and reviews, and the proof of concept is all kind of built into that. Conversely, starting a business is about justifying assumptions, right? Writing a business plan is about explaining where those sales come from, justifying the price, the cost of creation, explaining it in insurance policies that you have to acquire, management techniques, organizational charts. All of those things are trying to explain and justify how a new business will work. An existing business is simply an explanation of what has already worked. So that business plan, if you're writing that for funding or you're writing that for yourself, is a lot simpler, right? There's no justification needed. It's simply an explanation and understanding that historic role, right? So what that does is it really frees you up as a buyer to step in and leverage what your investment is, your energy, your growth and your focus, whatever innovation that you bring to the table, your skill sets. We'll talk a little bit more about this, but if those align with a weakness or a shortcoming in the business, that's fantastic, right? Then you have the chance to take that business to the next level. So what are you actually buying? Like we say, okay, you're going to go out and buy a business. We look at two different things to buy, right? You have your tangible assets, which are the things that you can pick up and measure, right? That's your furniture, your fixtures, your inventory, your equipment, phones and computers, the laptops, the desks that they sit on, a location, right? Sometimes buying it includes real estate or it includes an assignable lease, and you can look at that and say, okay, they've put this work in, they've put in the countertops or the three-bay sink or the dishwasher's in place or the hood, ventilation system has been installed. It is a functional turnkey opportunity. So those are all tangible things that you can walk through the space and say, by buying this business, I am getting these things. The other kind of field that we look at or things that you are acquiring are called intangible assets. The intangible assets are essentially the things that you cannot touch or pick up, but have value. It's the phone number, it's the website, it's the customer list, historic financials, trained employees, SOPs, right? Existing vendor relationships with terms that they might, consider offering you rather than terms that they would offer a new business, right? All of these things working together are usually called goodwill, goodwill value. And that's where, this webinar, our discussion today, it really digs in because tangible assets, these things, we can go out and find replacements for easily enough, right? If I want to buy a chair, I can go look at other chairs on Amazon or Office Max. If I want to buy a computer, I can go down to Best Buy and find a comparable computer, right? So I can put a price on these things, and I understand how a market looks at these things to determine value, wear and tear, age, functionality. These things are much more difficult to place a value on. That's why we pay a broker a lot of the time. That's why there's a lot of negotiation and discussion. That's why I'm recording an hour-long webinar on the topic, right? So my definition of goodwill, right? How to define goodwill and how to justify a price is this. It's the ability of those things, purchased assets. Assets are both tangible and intangible. I am buying the business in its entirety. And it's the ability of those things that I am buying to reliably generate excess cash flow. We're going to dig into it. So, quick catch here, right? One thing to look at here, and we'll revisit this topic a couple times, but these assets are only valuable. They only create value if they are transferable. You can buy them and receive them, right? So if those things are written down, that is fantastic. Then you can buy them as an asset. You can get them and you can follow them. If that is purely the knowledge of the seller, it is impossible to pull the value out of that transaction and say, I am buying those things, because those things will leave with the seller and they are not transferable, right? So one question that I love a buyer to ask, and I encourage my buyer clients to ask regularly, is simply this: when was the last time the seller took a vacation? The seller responds and says, I haven't taken a vacation in years. I don't think I could. That is a red flag, right, as a buyer, because if they are unable to be removed from the business, if they are the business, then what are you buying? Those assets, that goodwill value, leaves the day after the transaction. So how can you pull that out and make those things transferable? Let's dig into my definition again. So it's the ability of those assets that I am buying to reliably generate excess cash flows. What is cash flow? A couple things here, right? So one, it is legal and it is demonstrable. Oftentimes, for purposes known only to the seller, usually to reduce their tax burden. Not oftentimes, but sometimes they will say, oh, well, historic cash flow isn't quite up to speed because we get a lot of cash buyers, and sometimes that cash doesn't quite make it into QuickBooks. That's fine. That's their determination. I'm not the IRS. I'm not here to pass judgment on that. But if it's not demonstrable, then you are not buying it, right? You are buying what is demonstrable and you can look to. Similarly, if there are illegal or questionable business activities behind the books, don't invest any more time in that. That is a dangerous road to go down. So we usually start with tax returns, right? So sometimes the internal financials are a good starting place, but we ask for the tax returns historically because a tax return at least passes the straight face value of an accountant has signed off on it and it's been submitted to the federal and state government. So that is demonstrable to the level that we can hold most Main Street businesses to, right? Have they filed their tax returns? Can we use those? And then we ask for 2, 3, 5 years of historic tax returns. And we try to understand the story it tells, right? What is the trajectory of the business? Are there consistent customers coming in the door? Are there processes in place that maintain continuity despite employees coming and going and so on? So what are those things? So, do you need to learn Excel? A little bit for this part because it's easier to do that. And we're just going to talk through kind of what it is that you're buying and how that excess cash flow can be identified in a tax return. So quick crash course, some financial statements, right? Income statement is what your business does or is doing over a period of time, month or year. And a tax return looks at the year of performance of that business. The balance sheet is what you are buying, right? It is the assets you purchase. It is the liabilities, the debt you take on to buy those assets. And it is the equity that you invest, right? So that is the balance part of the balance sheet. Is if you go out and buy a $500,000 business, you have tangible and intangible assets. Boom, you've got your assets, right? How do you buy that? It's like buying a house, right? I can borrow money or I can invest my own money, but I have to come up with 500,000, right? So maybe I borrow 400,000 and invest 100,000 of my own. Now I have a balance sheet that balances. I've invested debt and equity into my assets. So those two financial statements, I'm buying this business and then I'm using the assets to generate cash flow, right? Create cash flow statement. So the income statement is that demonstrable cash flow that says, okay, I have excess cash. My assets generate revenue. I cover my operating expenses. I have something left over to pay my debt or reinvest in my balance sheet. We make this complicated for two reasons. One, that tax return, we really want to look at operations. That's that excess cash flow. And so we want to take out their balance sheet transactions. We don't care about their debt. We don't care about, their liabilities. And we care about their performance. And so we look at those tax returns to say, what have they paid taxes on? What is their performance? What is their utilization of assets? And then, for your own wherewithal, that income statement is how you will pay taxes. And so understanding the tax implications there, right? So as we look at that income statement in their tax return, that profit and loss, there's really three parts that we're going to look at. So the first is revenue. That is the most important. Is there money coming in the door? Are there customers lined up? Are there people paying for the service or the good provided? And then you look at your operating expenses in two buckets, right? So you have your direct cost or your cost of goods, which says of every dollar I make, to make that dollar, I have to spend 30 cents on material costs, right? Think of it like a restaurant. That plate of food costs the restaurant $4, but they're charging you $15 for it, right? So that cost of goods is what it costs to put that food on the plate. And maybe you have direct labor in there, the sous chef and the chef in the back that is creating value on that plate. And then the customer pays more for it, right? So those are the direct costs. Now, the indirect, the overhead costs, like the insurance, the utilities, we got to keep our lights on, even if nobody's buying food, right? So those are fixed. Those are what you have to pay month in and month out just to stay in business. So the questions that you will be asking as you look at the revenue and the things you'll be thinking about is essentially, what is the price per item that has been sold? And what are the number of items or services procured or purchased? What's their marketing budget? How does that fit in and drive sales? How many customers are return customers versus coming in new? What's their value proposition? How do they position themselves in the market? How diverse are their services or products that they offer? How many locations do they have, right? All of these questions feed that top line, sales and revenue. Conversely, as you dig in further, those cost of goods now are in that second section of the income statement. You're talking about systems and efficiency and training and SOPs, and where do they buy their raw materials or their raw inventory, and how do they create value with it and create additional value that they're then passing on to the customer, right? Is the staff consistent and well trained and efficient? Do they have follow the same recipe or processes in and out? Are there pro formas in place to hold them accountable, or do they do retroactive look backs and say, okay, we performed as we expected against this price point and this value? One of the most important things you can look at as a buyer is the gross profit line, right? The gross profit line is essentially revenue minus cost of goods, is what we sell it for compared to what it costs us to create. And the difference in those two things is the value that you are communicating and that the customer is applying to you. So the customer's willingness to pay more than the cost of creation is a wonderful indicator of goodwill. They are overpaying because they assign value to the processes, the systems, the uniqueness of what you are creating, right? So this is a great thing to lean into and look at as a percent of your total revenue. For every dollar we sell, we keep 40 cents. It costs us 60 cents to create the inventory, and we keep 40 cents, right? How does that compare to prior years? Is that value going up? Are they increasing their value proposition to clients and communicating that effectively enough that the price can go up, that they can increase their price? And then the last one we kind of take a cursory look at, right? Overhead is fixed. It should be more or less the same year in and year out, probably going up 3 to 5%. Rent, insurance never really comes back down, utilities, legal fees, right? So we look at those and we consider them as a dollar amount, and we say, okay, are these things going up? Are they coming back down? And we track cost of goods as a percent of revenue. So the more we sell, the more we have to spend there. And the less we sell, the less we have to spend. If we don't sell anything, we don't have to buy food to put on plates. We still have to pay our overhead. And that's what the business is. That's what you are buying, is this, right? It's a relatively simple formula that explains an entire effort and enterprise. It is, am I selling enough at a high enough value proposition to cover my overhead costs and have something left over? So very high level perspective of the income statement, which is important because this is when we start talking about cash flow, right? That consistent, tangible, excess cash flow. And it starts with that little blue piece. So we've got a few years of tax returns. We've plugged it into Excel. We've made some changes. We've said, okay, we're not going to expense that. We're not worried about that. What does this do to my bottom line? And first thing I would say is compare year to year. Are there huge fluctuations and jumps? Is it trending in a direction that you like and want to continue? Is it trending in a different direction and you're like, I'm buying this at a discount because I've got to change the inertia of this? Are there questions that you have? Are there large miscellaneous or other that is a little vague, or is everything specific and clear? And then again, compare your cost of goods year over year as a percent of revenue. Every dollar they made, they spent 30 cents on ingredients this year. Every dollar they made the next year, they spent 25 cents on ingredients. That's great, right? It doesn't matter how much they sold, they were more efficient at it, made, had a higher value proposition. And then their overhead costs, okay, their insurance went from 10,000 to 11,000 to 12,000 to 27,000. I'm going to ask a question about that. Why did their insurance double, right? And then how much cash remains to pay out to your new balance sheet to support your debt? So let's talk about the two things that people look at and talk about when they say cash flow, right? So I throw cash flow out there. There's two terms, and we're going to focus on SDE rather than EBITDA. So seller's discretionary earnings is the most common for a business that is doing, I would say, less than 5 million a year in revenue. Okay. EBITDA is a term that people would use if they are buying a business doing 7+ million a year in revenue. Here's why. Here's the distinction, right? So both of them start with net income. Net income is this little blue piece at the bottom, right? So it's the operating business covers its inventory replacement, it covers its operating costs, and it has something left over, a little bit, right? We start there. From that, we add back depreciation and amortization, which is a non-cash tax strategy, and that will be determined by your accountant. So we add that back. We say, okay, that's going to be, we're going to figure that out later. We're going to ignore what they have paid or assigned to that expense historically. Similarly, we will add back interest because their debt structure is going to be different than your debt structure. So we say, okay, equity before taxes, before depreciation and amortization, and before interest. That gets us to EBITDA. That's essentially the cash available to support debt. That is important for larger companies because larger companies have salaries and CFO and CEO positions built into the operating costs, and that is, kind of predetermined by a market value, and those things are in place and their systems in place. So EBITDA is used for larger companies to determine the ability to support debt. For smaller companies, we also consider seller's salary, so owner salary, historic owner salary, and seller's discretionary earnings. That's probably the grayest one, and I'll give you a couple examples. But the reason we do that is because we acknowledge that a smaller company, owner-operator, that salary fluctuates a lot more. Some people don't take any salary out of a business. Some people take distributions after tax. Some people pay themselves less than most of their employees. So there's a lot of fluctuation. We have to account for that. So we add that back, which gives us a starting point. And then discretionary earnings, I would go back to those rules of thumb, legal and demonstrable. So there are perfectly legal and perfectly demonstrable ways to reduce a tax burden by expensing things through a business. And unlike a huge company where those expenses are immaterial, for a smaller company, more Main Street, those expenses add up and they're decent tax strategies. So things like professional development or employing family members at slightly above market rates, or a company vehicle that isn't necessarily necessary for operations, but is still part of the expenses, right? So these are things that I would, quantify and ask the seller about and see, is that cash that I would not necessarily have to spend as a new owner that would be available to me, right? So what do I need out of this that isn't necessarily aligned with how they have spent historically, right? Another really valuable one is rent, right? So a lot of the time for those small Main Street businesses, they own the real estate that they operate out of. And I see two things, right? So sometimes I see a business not pay any rent at all, and that makes the business look really good because they're not paying any rent. So that's all money that shows up in that little blue piece, that net income. And they usually do that when they're planning on selling, and they want to say, this business is great. Look how profitable it is. Look how much I have to pay in taxes every year. And you're like, well, you occupy 6,000 square feet of space in Westbrook and you're not paying any rent on it. And as a new owner, I can't replicate that, right? Or, I have to pay principal and interest on the real estate, if nothing else. On the other, flip side of that coin, I see businesses pay more in rent than they need to. And there's some tax strategies involved there, but that understates the value for the business. So look at that rent line, especially look at that rent line if the seller also owns the real estate, and say, is this rent assignable? Can I lock in at this rate, or am I buying the real estate and need to understand how that rent is going to support principal and interest on the commercial real estate that I am purchasing, right? So a couple of things to think about there, but that's why we primarily use SDE rather than EBITDA, is because the work I do at CEI, the clients that I serve and support, we're really looking at that small Main Street business. And so those fluctuations, those differences make a material difference, right? And sellers often overstate that discretionary piece. So I think it is up to you as a buyer to do that due diligence and say, is this legal? And is it demonstrable? Can I prove that it happened and that it is, non-operational? And is it above board? Or, if they've used tax strategies to look the other way and mitigate taxes, it's a pay now or pay later. So, if I'm talking to a seller who wants to sell in a couple of years, I say, show everything. Because if you don't show anything and your business is break even, that's a hard sell to a future buyer. So this is what it means to you, right? So you do that due diligence, you do that work on the seller side, and you say, okay, what is the historic net income? How have they reduced that with depreciation, amortization, interest, that back? What is their salary? How much have they earned out of this in the past? And what are those discretionary things that I may or may not continue? So that gives me a number to work with, right? What does it mean to me? Well, I got my own salary needs, right? You as a buyer are stepping in, you know what you need. You're like, hey, I've got my own mortgage to pay. I expect to make this. If I'm doing all this work, I can go get a job down the street for somebody else, but I have to pay myself, right, to do that. And then what you have left after that is the ability to support debt. And there's usually a 20-25% buffer that a lender will look at and say, okay, if you have $100,000 left, I'm not going to lend you so much money that you have to pay $100,000 in principal and interest because you're one broken coffee maker away from missing a mortgage payment, right? So they'll say, we'll lend you $80,000 worth of annual debt. And there's some fluctuation on that 100,000. And if you miss it, it doesn't matter. You still can make that 80,000 obligation, right? So there's a loan coverage, debt coverage ratio that you can apply. And then you can figure out, geez, I've got this much left to support debt. So we'll talk a little bit about, pricing in the future. But that's a great starting point, is to say, what kind of debt can this support? And if I know how much I can bring to the table and I know how much debt it can support, I've got a reasonable purchase price right there. Very intrinsic value. We're focused on just one opportunity. We're not looking out in the market. There's no, we'll talk about rules of thumb, but that is a fantastic starting point to say, is this a good business to buy at this price or not? Right? Because, this is kind of how I look at buying a Main Street business. Right? You have your ceiling, which is essentially saying, geez, for that much, for a $500,000 business, I can spend $100,000 to buy the assets. I can spend $20,000 on a new website and cell phone and insurance down payment and lease. And so I'm 120,000 in compared to a $500,000 asking price. That's a that's a lot of room for me to make some mistakes and still come out ahead of leveraging up $500,000, right? So what is that ceiling? It's your alternative. It's hanging a shingle down the street and going toe to toe with it, right? So that's your ceiling value, first and foremost. The floor is simply, geez, if I offer lower than this, then they're just going to sell the assets off and, come out ahead. So I can't offer lower than tangible asset value. Then we've got this market price. Market price is a very vague, ephemeral term. It essentially says at an arm's length, a ready, willing, and able buyer and a ready, willing, and able seller agree upon a price. So, that's what you're here for, is to try to figure out what is that price. That goodwill value gets determined after a market price is agreed upon. Right. So goodwill is actually the resulting calculation of an agreed upon price minus the tangible asset value. So if you're like, you know what, they're saying it's worth $500,000. I think it's worth $500,000. It can support $500,000 worth of debt after taking out my salary. It's worth $500,000. That is the market price. Right? You and the seller have agreed upon that it's worth $500,000. Goodwill is whatever's left after you say, okay, of the 500,000, 300,000 is tangible assets. Well, we both agreed it's worth 500,000. Therefore, goodwill value is worth 200,000, right? Gets us to the purchase price. So market price is determined first. That's really that agreement and your negotiation and your determination of value compared to the seller's determination of value. If those things align, then the goodwill value is determined, right? One good rule of thumb for you to be thinking about, right? It's easy to think ahead, especially if you are an entrepreneur and you're like, hey, I've got these skill sets. I can do this. I know where this business is going. I'm the right person for it, right? Don't buy what it's going to be. Don't fall in love with a business based on what you think you can do with it, right? Or what the seller thinks you can do with it. A lot of the time, the seller is really confident that you're going to succeed, right? And that's wonderful to have that. But if the seller hasn't done it, it's harder than it looks, right? So sellers oftentimes, especially, if they've been in the business for a long period of time and are burnt out, they say, oh, you just have to do this. You just got to do this. Just got to have a little bit more energy to do that. And this business is going to up, right? Well, if it's that easy, then they would have done it, right? So buy what it is. Use that historic tax returns, that historic performance, and say, I'm buying it as it has been, as it has performed. What I do with it, it's my equity. I'm going to invest that energy. I'm going to do those things which have not yet been done, which will create value for me, right? It's like flipping a house. I'm buying an old dumpy house that's, I think I can flip and sell for 500,000. I'm not going to pay 500,000 for it because I've got to put time and energy and effort into it. And if I buy it at 500,000, I'm chasing to get there, right? If I buy it at 200,000, that's what it is. And I invest my own time and energy and I get to keep the difference, right? That's the same thing with the business, right? Buy what it is or pay for what it is, buy what it's going to be. See that opportunity. And this is how that translates to what we've been talking about, that cash flow and performance, right? So you look at that and you say, okay, I've got my seller's discretionary earnings, my historic performance. I've looked at that. I've done those add backs. They're legal, they're demonstrable. I have that tax return history. Got my number that I'm starting with. I know my own salary needs and I know what can support debt. Well, once I know what can support debt, pretty easy to figure out what terms are. Right now, anywhere between 7 and 10% interest rate, usually 5 to 7 year term length on a business, depending on, how much assets and, how consistent the history has been. And I know my own ability to get a down payment. So, hey, I know my supportable debt that I can take on based on the ability to support that debt, right? If I've got this much cash left over after my own salary, I could support this. Well, if I overpay for that, if I'm saying, hey, historically, it's only done this, but I'm going to pay a little bit extra because that's what the seller wants and that's what I think it's worth. The only other place that cash can come from is your salary, right? The business is what it is until you make operational changes and improve it. But you're taking less salary until you get there. And if that's 30 days, great. If it's 6 months, okay. If it's 5 years, like when is that point where you're like, hey, this is harder than it looks. I overpaid and all I did was take less than what I'm worth, to carry this debt, this, boulder that I'm carrying. So if you're overpaying, do that calculation. How long do I think it will take to turn this ship and get that SDE up enough to pay myself and to support this debt that I am taking on? And that's a calculation, even if you're paying cash, you should be doing, right? To say, is this worth my time? Or is this money that I have better invested elsewhere? Because if that return isn't there, if you are working 80 hours a week to break even and pay your employees more than you pay yourself, it's an expensive hobby, right? So make sure that you are putting yourself in a position to succeed, that upside, is yours to keep, not yours to recover. And that's, as this says, in my experience, this is the best way to determine if this is a good business to purchase at this price point or not. I'll talk about some rules of thumb on, market multiples and how that's determined and what goes into that. But that internal approach to business valuation, to an opinion of value, saying, does this support the debt that the seller is asking me to take on in order to acquire it? Is that breaking point? If not, you're chasing the whole time, right? Multiples often, like I said, get thrown around a lot. A lot of these are just pulled out of, the business reference guide, which is a book, or an accountant's rule of thumb, or there's some IRS data on historic transactions. There's a couple databases out there that you can get rules of thumb. A rule of thumb is essentially saying, okay, as an example, if a business has consistently done $1 million in revenue in sales a year, and that business sells for 500,000, then that multiple is 0.5, right? It is half of revenue. And so that is an example of how you find a multiple or look at a multiple. And then if the business you're buying is doing 600,000 a year in revenue, you'd say, okay, apply that 0.5 multiple, and that gives me a value, starting value of 300,000. Conversely, there are multiples for SDE, the cash flow, right? And 2x your cash flow, or 5 times your SDE, right? And you can do the same math. You can say, okay, if the SDE that I've come up with after reviewing this historic financial statement times 2 gets me to 200,000 or 300,000. It's a starting point. These rules of thumb are exactly that. They're this, right? It's just a guess almost. Does not take into account how recently the equipment has been serviced. It does not take into account the employee turnover. It does not take into account inventory on hand, right? It is just a starting point. Right? The other thing I'd point out here, I don't think I have a slide on it, but which multiple you use is hugely important depending on what type of buyer you are, right? So often I will have somebody say, well, the seller told me it's a 0.5 multiple of the top line and they do $1 million in business. So our starting, value is 500,000. So, okay, it's a starting value. And then we look at it and it's been break even or loss to the bottom line for 3 years. And so, the question is, can this support $500,000 in value? No, it can't. It's barely covering its own operating costs, right? Top line multiple does not matter to you at all if you are an owner operator looking to replace the seller, because all those expenses are going to be the same until you do something about it, right? So that bottom line multiple is the only thing that matters, that cash flow multiple. When a top line multiple is useful is if you are a synergistic buyer. Usually I see that with like accounting practices or law firms or sometimes medical practices where they're saying, hey, all of our expenses are the same. We just want your footprint. We want your phone number and we want your customer list. That's all we're looking at, right? So, depending on what kind of buyer you are, really dictates what multiple makes sense to look at. If they want to take that 0.5 times the top line multiple and go shop that business to their competitors or to their vendors or to, some key customers, great, good for them. Let them go do that as a seller. As a buyer, that is not a good starting value, because servicing $500,000 in debt when you're starting at zero is going to be a tough hole to dig out of. Don't do that to yourself, right? So a lot of room for interpretation there. If you are using a rule of thumb or a multiple to get started, know which one makes sense for you and explain that, to the seller. Talk about structuring the deal a little bit. So if you're doing this through a commercial loan, a bank or a, CDFI or, a council of government somewhere, they're looking first and foremost at physical assets, right? If you're buying real estate, if you're buying equipment, inventory, they have what's called a loan to value ratio. And a loan to value ratio is essentially they're willing to loan against the value at a percentage. It's usually not 100%. Right? And the reason for that is because a typical lender, a typical bank says that real estate's worth $1 million. We agree, we got an appraisal done, it's worth $1 million. But if we miss a few payments and we, the bank, have to seize that property and we have to pay an attorney to file, a new deed, and we have to pay a broker to review and post that, and we have to pay a percent commission when they turn around and sell it, and we have to pay utilities to maintain that while we own it. We're not going to get $1 million out. We're lucky if we get 900,000 out, net all of those expenses. So we'll lend you 80% of the value. Our loan is 80% of the value, right? So that loan to value ratio is what you are, looking to the bank to explain to you because the difference is your equity, right? Think about the assets you're purchasing versus debts and equity. That balance sheet has to balance, right? So if the bank is saying we'll lend 80% of the real estate value and 70% of the furniture, fixtures, and equipment value and 50% of the inventory value, you can do those calculations and say, okay, well, what do I have to come up with? Now that you have to come up with piece of it isn't necessarily, isn't necessarily your cash. You can have other assets that you bring to the table, like a personal guarantee or a second position on your home. Or you can look to the buyer or the seller and say, okay, we both said that this is worth 500,000. I have a bank that is willing to lend 400,000. I can bring 50,000 to the table, and I need you, the seller, to wait on the 50,000 and get paid in a secondary position. And that gets us to 500,000. I've also seen contracting agreements where you say, yep, at a flower shop a while back that said, I will be available as a seller to you, the buyer, for 5 phone calls a year, and each phone call will cost you $5,000. Right? And we'll do that for 2 years. And they called them before Valentine's Day and Mother's Day and some of the other major florist holidays, right? But that was a great way that they had kind of a consulting agreement where the business paid an additional $50,000 for 2 years of phone calls, right? That's an extreme example. I don't know if it was fully legal. I wouldn't, I'd always have an accountant or an attorney review something like that. But can you keep the seller on for a period of time? And are they willing to take some of their compensation that way? One thing we've also seen recently is lease agreements where the seller retains ownership of the real estate in exchange for, a slightly above market or reasonable but profitable lease. And the buyer says, yep, I can pay you $400,000 and I'll commit to, this lease for 3 years or 5 years, right? So where's that opportunity to work with the seller? You say, okay, we've got the starting point. We both agree that it's worth 500,000. Now what? Where does that money come from? Well, I can borrow some. I've got friends, family, and fools. We can, work on a compensation agreement. We can redo the lease. What is that opportunity to get to that $500,000? Common timeline, just to be thinking about. So first and foremost, there's usually a confirmation of interest. If you were a buyer in the market and you were looking, sometimes that is just a one page, right? A lot of these businesses are sensitive about being publicly for sale. And so it's usually a teaser document. It says like service business in mid coast, 4 million in sales, $300,000 SDE, purchase price, whatever, $2 million, right? You're like, I could be interested in that. And so you reach out to the broker and you say, I think I'm interested. What do you need me to sign so I can get more? It's a confidentiality agreement. That's a release. It says, I'm not going to use this information nefariously or sell it or whatever. And now I know what the business is, and I can determine if that is something I'm actually interested in. This is where it gets a little, bit of a gray area. Some people want to do more research, and the sellers are willing, once that confidentiality agreement is signed, to release some. And some sellers aren't. Some sellers say, you know what, I've given you enough information. I've given you some top line and bottom line information. If you're interested, then make an offer. Right? And you can have a letter of intent that outlines those terms, which is kind of like just a confirmation that, yeah, what I see is worth this. Is that something that you're willing to accept? I'll pay you 1.5 million for that. And the seller says, okay. The purchase and sale is really the important document. That is an actual contract between you and the seller. There are usually two contingencies in a purchase and sale that are most important to you. One is a due diligence contingency, which is an inspection. Think of it like buying a house. You have somebody come and tell you that the bones are good, there's no mold. You want the same thing with the business. You say, okay, you've told me that you're doing 4 million in sales. I want to see historic customer lists. I want to walk through the location. I want to meet the employees. I want to have my accountant review the historic financial statements. What is it that is that due diligence period? I think we have some due diligence checklists. If that's something you're interested in, please reach out. And then the other contingency, similarly to buying a house, is a financing contingency. You say, I will buy this business from you in 90 days. I want 45 days to do a thorough review of what I'm buying, make sure those assets are transferable, tangible, and I trust them. And I need to secure a loan of whatever, $2 million at an interest rate not to exceed 9%, right? Whatever, I'm making it up. But the financing contingency is that opportunity to say, I'll buy it, but I need the money to buy it. I'm not paying cash for this. And I need to know what I'm buying is what I think I'm buying, right? And just like buying a house, both of those contingencies give you an opportunity to renegotiate within the constraints of those deadlines. You say, I have 45 days to do an inspection. You do some of your inspection and you're like, ooh, this isn't, quite what I thought. You just lost 3 key employees. I'll pay you $1 million instead of 1.5 million and renegotiate. Or the financing, you go back and you say, I said I'd pay you 1.5 million. I can only secure a loan right now of $1 million. Do you want to come down on the purchase price, or are you willing to hold the seller note? How do we get to that 1.5 million? Right. So long as it's within the constraints of that purchase and sale agreement, that is the opportunity for you to do your due diligence, do the work, write the business plan, secure the loans, and close. Now, some documentation survives the close, it stays in place after that transaction takes place. So you have an employee contract with the seller, or a independent consulting contract. If you have them sign a non-compete, you don't want them going out and hanging a shingle and taking your key customers. Is there a seller note that you pay over a period of time after the bank gets paid off? AR collection and AP payoff is a big piece of this, right? So AR is accounts receivable. That is who owes you money or who owes the business money. And AP is accounts payable. Those are the vendors if they have terms, right? So if you say, okay, I'm buying this construction company and they're halfway done these 3 houses that I'm at the point that I'm buying, who's responsible to complete those houses? When are the payments coming due? How much has been paid already? Has it been paid in full? And now I'm obligated to complete these houses, right? So that AR AP question, as well as the inventory question, are all things that are worked through in that process, but understand those implications. Who is responsible to go out and collect unpaid receivables, who still owes the business money at the day of the close, and who's responsible to pay the vendors? If you have 30-day terms, with a major vendor and they owe the vendor $15,000 on the day of close, are you responsible to pay that, or is the seller, right? Who's that obligation fall to? Because even if it's technically the seller, but you want to maintain a good relationship with that vendor, maybe that's a point of contention. Maybe you say, hey, part of this closing costs and these purchases are clearing any historic debt to these vendors, these key vendors, because on day one of me owning the business, I don't want them to have a bad taste in their mouth that you owed them $15,000 and moved to Florida and they can't get hold of you now, right? So a couple things that I think are just worth running through, right? So first question I always ask is the owner replaceable? When was the last time they went on vacation? When was the last time they stepped back? Are there key employees that have that information, standard operating procedures in place, like policies? How long will it take before you have to pick up the phone and call them after you own the business and say, hey, what do you do about this? I'm coming up with this issue. I can't log in, to my Facebook account. What is that thing that, makes them replaceable, easily replaceable? What contracts can be assigned? Can the lease be assigned? Do they have customer contracts that can be assigned to you to execute? Do they have vendor contracts that can be assigned to you to, honor? What can or should be renegotiated? Is the capital equipment well kept? That's always worth looking, especially if it's capital intensive, a lot of big pieces of equipment. There's a lot of value, and there's a lot of cost in repairs and maintenance. If that is deferred because the seller is like, you know what, I'm going to sell in a year, I don't really need to replace those tires quite yet. Let the buyer deal with that, right? Some deferred maintenance is common with sellers, especially if the business has been on the market for a while. So take a hard look at that. How much money do you need to set aside for deferred maintenance and repairs in those first 6 months or year? Do your strengths coincide with recognizable weaknesses? This is a big one because I think the instinct humanly is to look for businesses that have the same strengths we do. Right? Look at that and we say, I'm a great marketer and they've got a fantastic marketing team. This is going to be really fun. I'm going to be able to work with some of these best, marketing employees that they've got. You don't move the needle there though, right? So understand where your strengths and your experience are. And if that happens to coincide with the weaknesses or a hole, and you say, geez, on day one, this website, it hasn't been updated in 15 years, and I can do that on a weekend and just make it much more streamlined and get, all those clicks we're getting to actually convert to sales. Fantastic, right? That's that equity opportunity. You're buying a house and the bones are great, but you're a plumber and all the electric needs to be redone. Don't buy that house. Buy the house as if the electric's great and all the plumbing needs to be redone, right? What is that weakness that you're like, yeah, man, they do not do this well, and I can do that very well. So align that. Long-term customers, I think, is an understated asset. So look for you can request a, customer list by year, by sales, and just say, okay, this customer has been a repeat customer and is consistently coming in, or is there a huge diversity in customers? That can be good too, right? There are 500 customers that, are turning over, but, it's consistently 500. Two risks would be, big accounts, having 70% of sales, in three key customers. There's a lot of eggs in one basket, so take a hard look at that. Similarly, vendors and employees, right? How long are their key employees in place? And that cuts both ways, right? If you have three key employees and they've never taken vacation and they've been there for 25 years and there's no SOPs and no systems because of the three of them just have done it well for forever. Okay, how transferable is that and how much value do you place on that? I actually saw one deal recently where they structured a portion of the purchase price to go to some key employees to be paid after a period of time. Essentially say, okay, business is worth $1 million, but I'm going to put $50,000 into this escrow account and divide it among these two employees if they're still here in 6 months. And if they're not here in 6 months, I'm going to keep that as the buyer because the value's not there. The value left when the seller did and those key employees did, right? So how do you keep that skill set and that value, at least as far as it takes for you to train somebody else or cross train or pull that into an SOP or procedure to mitigate that risk of having them walk, right? Build your team, right? This is a big one. I would say, an attorney and an accountant are hugely helpful in this process, especially if you already have a business that you were planning on buying and have a rough idea of the price. Get an attorney, get an accountant to help with that due diligence process, help with that purchase and sale contract, help with anything that survives the close. If you were entering the market and you were saying, I want to find a service business in this region and I have this much to put as a down payment, a broker is a fantastic person to work with. A broker can help you find opportunities. If you already know the opportunity, a broker's value is somewhat diminished, but can still be helpful with that negotiation part if you're uncomfortable doing that yourself. And then a banker, I think that's another one. If you're planning on taking on any debt through this process, building that initial relationship, saying, okay, what other services do they offer? Does this bank do payroll in-house? Do they do retirement accounts if I'm planning to offer that? I'm going to go ahead and open a checking and savings account with this bank so that they can see that I have cash on hand, ready to go. And, what's their due diligence process look like? For banks, I really do like local savings banks. I think that's kind of the sweet spot for commercial business acquisition. Larger banks, with an 800 number, you tend to just speak to some random person every time. Too small, kind of the credit union size, they're a little inflexible because of the constraints within their department. That Bangor Savings Bank, Norway Savings Bank, Gorham Savings Bank, Franklin Savings Bank, those savings banks, Main Street savings banks have a vested interest in maintaining the business operations and keeping that going. They're in the communities. You usually work with the same lender, whether it's buying the business or buying new equipment a couple of years from now. So find that person that you want to work with in all of those spheres. Find the right attorney, find the right accountant. Those are things you could be doing now. Interview a couple, say, this is my plan. Do you have experience in this? Can you help? If you do enter into a partnership agreement, this is that seller note, that compensation agreement that survives the close where the seller stays there. Good contracts make good neighbors, or, good fences make good neighbors. Good contracts make good partners, right? So think about responsibilities, think about obligations, think about the exit. Okay, you're buying their baby and they're going to object to how you treat that baby or how you discipline that baby when it comes time that the baby's doing something wrong, right? So understand that they're going to have their own opinion and their own, insights, which can be incredibly helpful, but also sometimes can be disruptive. So say, okay, here's the lane. I'm going to stay on my side and you're going to stay on your side. Here's what I'm paying you to do. It is these things and limited to these things, right? So that compensation agreement, that partnership agreement, that employee agreement, whatever it is that is tying you to somebody for that period of time, think about the start, how do we start this? Who owns what? Think about the life, who gets to make purchasing decisions, who gets to, control these aspects, who gets the final say, and think about the worst case, death or divorce. When can you force their hand? What does that look like? Do you have to find, other cash, to bring to the table and buy them out, or what is the obligation there that you have to them? Couple due diligence things that I would just put out there. Tax returns, always the greatest starting point, because that is the ability of those assets to generate cash flow, right? So you look at that. Organizational charts gives you a list of those employees. Equipment list, digging into that, giving that to somebody who knows the equipment well enough and can review that with you. Sales by customer reports, ARAP, inventory on hand. What does that look like? Age of inventory is often, important caveat there. If they're like, yeah, we've got $300,000 in inventory sitting on the shelves, and then, well, 250,000 of that is 3 years or older, but we we just like having it on hand in case somebody's looking for that old set of screws or whatever, right? So, okay, well, the value's not really 300,000 then. It's probably like 50 to 100,000 because that older stuff just doesn't have, it's non-operational at that point, right? There's no buyers out there for it. So look at inventory, yes, but look at age of inventory, look at inventory turns, figure out what the high SKUs are, and go from there. Um, Contracts, any contracts that would be assigned or contracts that would be assumed, make sure you're reading those and having an attorney review them. IP, you'd want all of that information, passwords, access, keys to the building, yes, but keys to everything that you were purchasing, right? Social media accounts, you're not paying for them unless you have access to them and can continue them. Licensing, permitting, are those things assignable? Do you have to go out and get your own license? How long does that take? Do you need that license in place on day one to assume operations? If you're proposing that you close the business, close on the business and buy it in 45 days, and the average time to get, I don't know, the liquor license necessary is 90 days. Are you going to just not serve liquor for 45 days until that license comes in, right? How does that work? So look at those timing questions, look at that cash in and cash out. And if you're unsure, then that's where the attorney or the broker or the accountant come into play, right? Ask those questions of those professionals. It is worth getting that feedback back, even if it is expensive to pay for their time. It's a lot less expensive than figuring it out after you buy it. If you do have any questions about this process, if you want to dig into a specific opportunity and determine if it's right for you, please reach out. CEI offers many kinds of business support. We love talking financials, marketing, human resources. If we don't have the answer, we can point you in the right direction. It's a free service that we offer. It is confidential within CEI. I have my own, email address here if you'd like to reach out to me, or you can go to our website, ceimaine.org, and request an advisor. We have, I believe, 8 advisors across the state, all providing similar services and here for you. Thank you all. Be in touch.